Hello. In this video, we'll be going over non-cash acquisitions for long-term assets using exchanges with other assets. So when companies acquire assets without paying cash, they can do so in different ways. They can have deferred payments, which means they issue a note payable, or they receive, they issue a note payable. They can issue equity for those acquisitions. They can donate assets, and this is what this video is talking about. They can actually exchange assets for other assets. When that happens, an asset that is received in an exchange for non-monetary assets, so one asset for another, is generally valued at the fair value. So what that means is we take an old asset, right, and we see what their fair value is, and we trade it in for a new asset at their fair value, and any difference between the two is either paid in cash, or you could also trade in another asset. And then if there's still a difference between the fair value and book value of the asset given, right, the old asset, then you recognize a gain or a loss. We're going to go through some examples that I think will make it a lot more clear what this whole slide is saying. There are 4 steps to follow when you record a non-monetary asset exchange. First step is you record the new asset at its fair value, and that fair value is determined based either on the fair value of the asset given up or the fair value of the asset received. Usually in an exchange, we expect those two values to be equal. Next step is you're going to remove the book value of the non-monetary asset given, meaning the one you're giving up. And the book value means its cost minus its accumulated depreciation. Step 3 is if there's any cash received or paid, you're going to record that entry. And then step 4, if there's still a difference between the fair value and book value of the asset that's given up in step 2, then you're going to record a gain or loss. Let's go through an example and see how all these steps take effect. Okay, the Elkhorn company traded its old laser equipment for the newer air-cooled ion laser equipment manufactured by American Laser Corp. The old equipment had a book value of $100,000, which is made up of it cost $500,000 less it has $400,000 of accumulated depreciation, and it has a fair value of $150,000. Elkhorn also paid American Laser $430,000 in cash as part of the exchange. The first step says record the new asset at fair value. And we learned in the previous step, in here in step 1 right here, when we record the new asset at fair value, that fair value is determined based on the fair value of the asset given up or the fair value of the asset received. Well, we're not told the fair value of the asset received. In the problem, we are told the fair value of the asset that's given up, which is $150,000, right? It says the old equipment has a book value of $100,000 and a fair value of $150,000. So the fair value of the asset given up is $150,000 plus, which is right here, which is considered to be the fair value of the new equipment received, plus any cash paid is also included in the fair value of the new equipment. So the first step to this entry is to debit the new equipment for $580,000. Step 2 is remove the book value of the non-monetary asset given, which is the cost minus accumulated depreciation. So step 2, here here's my step 1, right, the new equipment. Step 2, I'm going to credit the old equipment cost of $500,000 and debit the accumulated depreciation of $400,000. That's how I get it off my books. Step 3 says record any cash received or paid. So now we're going to record the cash because it says we paid cash of 430. So this is step 3 right here, right? The cash paid is step 3. We're going to credit step 3. And then step 4 is to record any gain or loss which is equal to the difference between the fair value and book value of the asset given up in step 2. So let's look at that. The gain, the fair value of the asset given up in step 2, we're told is 150, minus the book value is 100,000, right? That's the 500 minus 400. So we have a gain of 50. So we're going to credit gain on exchange of assets of 50,000. That's how we get to this entry when we exchange 2 assets and it's a gain. Now let's move forward. And what if the facts of the problem are the same, except the fair value of the asset given up is now $75,000. Same, we go through the same steps. Step 1, let's record the fair value of the new equipment, which is equal to the fair value of the old equipment, of the asset given up, plus any cash paid, which is 505. So we're going to debit 505. We're going to take off step 2 is remove the book value of the assets given up, which is the old equipment. So we're going to credit equipment 500 and debit accumulated depreciation 400. So now this is what our journal entry looks like. Step 4 is record any cash received or paid. So we paid 430,000 right here. And then step 5 is calculate a gain or loss based on the difference between the fair value and book value of the asset given up. And the asset given up in this example, the fair value is 75 minus the book value is still 100. And so we have a loss of 25. So we're going to debit loss on exchange of assets of $25,000. And this is what that entry looks like. I think it's easier to do this when you go step by step, and because it makes more sense that way. Now, sometimes the fair value of the asset cannot be determined. The fair value of the asset given up cannot be determined. So here we have the same facts. The Elkhorn company traded its laser equipment for a newer laser equipment. The old equipment had a book value of 100,000, and the fair value of both the new and old equipment is not determinable. We could figure out the fair value of the new equipment if we had the fair value of the old equipment or the fair value of the new equipment. That's what we would use as a fair value. However, neither one of those is determinable in this example. And so that's when it says fair value is not determinable, like when we don't have any fair value for the assets given up or the assets that we've received. And Elkhorn still paid $430,000 in cash. So when fair value is not determinable, we're just not going to have a gain or loss. Your new asset that you received is going to be equal to the book value of the old asset that you gave up plus any cash paid if there is cash. So we're going to credit our equipment for 500,000, debit our accumulated depreciation for 400,000. That's to get our old equipment off of our books. We're going to credit cash for the amount paid, which is 430,000. And then the new equipment is just going to be the plug. So in this situation, the new equipment is the 530,000. It's the book value of the equipment given up plus any cash paid, which is 430,000. Notice there is no gain or loss recognized when the fair value is not determinable. It's just you're putting the book value of the old asset into the new asset plus any cash paid. There's a concept where an exchange lacks commercial substance. And the reason why we have this rule is you can only record exchange for non-monetary assets when the transaction has commercial substance. And we'll go into what that is. And the reason for that is because you don't want to be able to record an exchange that doesn't have commercial substance just for purposes of recording a gain. So this is just when we have to record a gain. So imagine that we have an old asset, an old equipment, and it's worth $1 million. And we receive new equipment, and that's equal to $5 million. And the way we would record that, right, is and let's just say there's no cash involved, we would credit the old equipment for $1 million, and then we would debit the new equipment for $5 million, right? And let me just, so it doesn't get mixed up. And then how would we balance this transaction? Well, if this happened, we would have to credit gain for $4 million. So imagine if you could do that, if a company could do this all the time, they would say, oh, I'm just going to exchange one asset for the other and record this huge gain and increase my net income on my income statement. Well, GAAP says, no, you cannot do that if the exchange lacks commercial substance. So an asset exchange lacks commercial substance when the future cash flows of the entity are not expected to change significantly because of the exchange. So in simple terms, if you swap one asset for another and it doesn't really change your economic position, then the exchange is considered to lack commercial substance. And usually these assets are similar in use and value. So here's an example for lacking commercial substance would be if a company traded one delivery truck for another truck of similar age and condition and value, and the company would not generate any additional cash or significant cash as a result of that new truck. In that situation, the exchange lacks commercial substance. So a company will have commercial substance when when there's future cash flows are present as a result of the change. So let's look at an example here. And newer models of equipment can increase production or improve manufacturing efficiency, causing an increase in revenue or a decrease in operating costs with a corresponding increase in future cash flow. So when you have an exchange and you can it's more efficient by causing an increase in revenue or a decrease in operating costs, then the exchange has commercial substance. Now, if an exchange lacks commercial substance, right, the future cash flows aren't really going to change. And it would have been a gain, like in my situation of exchanging a piece of equipment of $1 million for $5 million. If it lacks commercial substance, then if you truly want to exchange that equipment or asset, the book value of the old asset is used to record the exchange. So the book value of the old asset is equal to the new asset. That's the fair value of the new asset. If an exchange lacks commercial substance and it would result in a loss situation, which is pretty unlikely, then a company can record the fair value of the old asset can be used to record the exchange just like normal. But most companies would not do this because it would generate a loss situation when in effect you've exchanged one asset for the other that won't really help you in the future. So let's look at this example. The Elkhorn Company traded a tract of land to Sanchez Development for a similar tract of land. The old land had a book value of $2.5 million and a fair value of $4.5 million. Elkhorn also paid Sanchez $500,000 in cash, and we have to assume that the exchange lacks commercial value. So if it lacks commercial value, that means that the book value of the asset given up is going to be equal to the fair value of the new land. So we're going to take out the old land of credit land of 2.5. Cash is paid, so that does increase the fair value no matter what, because cash is cash. So we're going to credit cash for 500,000, and then our new land is going to be equal to, we're going to debit it, capitalize it at $3 million. Notice no gain is actually recognized in this situation. So because it lacks commercial substance. Here's a slide just summarizing the exchange, just summarizing all the different rules for the exchanges. I'm not going to go through it. This slide is in the book, or you can just take a picture of it if you want right here and use it for reference. Let's do a quick concept check. Arizona Pharmaceutical exchanged laser equipment with a book value of $70,000 and a fair value of $75,000 for the newer model of laser equipment. In addition, the old equipment, $90,000 in cash was given. So what should they recognize? Well, step one is recognize the new equipment. We're going to debit the new equipment, the new one, at the fair value of the assets that were given up. And we're told the fair value of the assets that were given up was $75,000 plus $90,000 cash, right? So that's $165,000. So we're going to debit the new equipment, $165,000. Step two is remove the old equipment, the assets that you're given up, remove the book value of it. And we're told the book value is $70,000. So in this situation, just for sake of making it short, we're given the book value. Usually we're given the cost and the accumulated depreciation. So we're going to credit, we're going to take off the old equipment at $70,000. Step three is record any cash that paid or given. So we also paid cash, right? So of $90,000. And then we're going to have to record a gain or loss, which in this situation is a gain, between the book value and the fair value of the asset given up. Well, the book value of the asset given up is $70,000, and the fair value of the asset given up is $75,000. So that means we have a gain of $5,000. So here we go. We're going to do a gain of $5,000, and the answer is C.